what Coatue did is they polled all the founders in the audience. The poll results showed that on the one hand, everyone in the audience understood that we were headed for a big downturn and economic conditions and fundraising were going to be much tougher. On the other hand, all the founders, or 2/3 of them, said that they were going to use this downturn to accelerate their business as opposed to cut. My one-on-one conversations with the various founders basically are in line with that, which is it's all not me. I know everybody else is going to be impacted, is going to have to cut, but I'm going to be the one exception. And there will be exceptions, absolutely, but everybody can't be the exception.
The way the market works basically is you have buyers and sellers. And, to make it really, really simple, you have hedge funds as one class of buyer.
Sure.
You have ETFs, but they're not really
Exchange
because they have
funds.
Yeah, but they have fixed strategies. And so, they're hedging, they're moving, but whatever. And then you have retail. Okay. So it's retail and hedge funds. Those are the two main pockets of where the flows come into the stock market from. And you can get a real sense of what's happening, what the psychology of the market is, if you see what those flows are. And right now, what we see is that hedge funds are largely on the sidelines. What that means is they've been so battered and bruised. In some ways, I think they're licking their wounds, but they're mostly waiting. They do not find a compelling reason to buy, right?
But they have to buy at some point, right, Chamath? This is their business.
No.
Well, I guess they would have to find other opportunities, right?
Their business is to make money relative to their index. And so if their index gets torched, them doing nothing makes them look like geniuses. So they don't necessarily have to buy at any point. They just need to make money in the end.
I'll tell you guys some stories. I went to a conference in March with a lot of fund managers, probably managed several $1 trillion in total. People were like in shock and awe at that conference because they had taken such significant write-downs and they were still getting written down. So all their investments were off. They were off 40% from the peak. They were freaking out. Things were collapsing. No one was doing anything. They were all sitting on the sidelines, hanging out, waiting. I went to a conference last week, and so the tone and the demeanor was just like morose. Last week, I went to a conference with a lot of managers, also probably managing trillions of dollars across the pool. And people were just they had accepted this new reality and they were kind of willing to look at new things. And, they were no longer engaged in trying to shore up just their portfolio. And a lot of the stuff we talk about, which I think is tactical on the ground, how do we deal with our businesses and our portfolio of investments that we actively work with in the private markets, they were much more interested in kind of starting to explore and think about new things. And I hadn't seen that 3 months ago. So that's a positive sign. From a market participant point of view, I think that folks have kind of accepted a new normal, an inflationary normal, a high volatility normal, a normal of uncertainty, a normal of kind of recession. And as people have started to kind of internalize that new normal, I think they're now starting to say, okay, what should my action plan be? And that action plan is, I've got trillions of dollars of capital sitting on the sidelines. What should I start to do with it? So, my very, very, very anecdotal experience has been that significant market participants, I think, are going to start to perk their head up this quarter and start to think about doing new things. What that translates into in terms of, stock price movements and indices, I don't know. I've always said that there's going to be a huge variation in outcome during this year. And some industries, some sectors, some types of businesses will outperform others. And so I don't want to create generalized statements about indices, but I do think that capital activity is going to start to come back this quarter, where people are going to start to think about what to do rather than pull everything out because of the massive shift that's happened in the past couple of quarters.
Of course, we're still investing.
You're still investing.
Of course. Yes,
so as a
course.
market participant, you're investing. What are you seeing?
We're investing, but we see that the pace of deal making has slowed way down because founders know that valuations have gone down. The fundraising environment is tougher. So last year, they're raising every 9 months. Now they know they should probably be raising it once every 2 years. So the pace has slowed way down.
That's a good thing?
Yeah, I think
it's healthier.
It's healthier. Yeah, it's more normalized. Last year, the companies that could raise did raise. They have big war chests. So I think there's going to be a delay. It's definitely a slower period. We've done a couple of growth deals recently. I think the fact that Tiger and the other kind of crossover investors, the fact they've pulled way back from venture markets gives smaller firms like us an opportunity to do growth deals. So
how did you make the decision to invest in those companies?
They're both companies we've known for a long time, have wanted to invest for a while. So the opportunity arose to invest, and it was way less competitive than it would have been
So this is
last
what
year.
we would call opportunistic. You knew the firm, you had high confidence in them, and opportunistically they need money. Yeah.
We've basically done 2 deals in the last 4 months. And
what was your pace, let's say, 18 months ago?
It was a little faster than that for sure. There's just
Double,
more
triple?
deals happening.
I always said it doesn't matter if you find a great business and you believe in that business over the very long run, you don't need to worry about timing the markets. You put money in that business, as long as you get a fair valuation for it today relative to what it should be priced at based on what markets are telling you today.
Well, and a 20 PE would be more than fair historically.
Maybe, who knows? But whatever that is. But if you find a great business that you think is going to compound value for you over the very long run, market cycles don't matter.
And long run, you mean a decade?
Yeah, call it a decade. And Sachs's business he's invested in, these are tech companies that I don't think they're planning to go public next year. He's making an investment in a business that he considers to be a great business that can compound value. Not compound valuation, but compound business value, meaning they can do something more valuable next year than they were doing this year and continue to accrue an advantage in their business that allows them to accumulate earnings over time or accumulate revenue that ultimately translates into earnings over time. And there are many businesses that are public that operate like that regardless of any of these turtles popping their head out, those businesses will perform well over the next decade. And I think, that's always a great place to invest.